Welcome to vTalkInsight, Market Drivers Daily for June 3rd, 2026. AI exuberance, surging energy prices, and growing liquidity stress in private markets are colliding today, reshaping how risk is being priced across equities, rates, and credit. Let's start with the AI engine that is still powering this market, even as the cracks around costs, capacity, and regulation become harder to ignore. The dominant force in global risk assets remains the AI build-out, which is evolving from a straightforward growth story into a capital-intensive cycle with broader macro fingerprints. U.S. AI infrastructure investment has surged to about $750 billion, roughly tripling in 2 years, while hyperscalers are projected to spend more than $700 billion on data centers this year alone. That accelerates the shift we have been tracking in recent days from capital-light tech models to balance sheets, increasingly tied to large, long-dated infrastructure projects. This wave of spending is feeding directly into earnings expectations. 45 key beneficiaries of AI capex in the S&P 500 are expected to grow earnings by about 70% this year, and consensus now sees broader S&P earnings growth around 20% in 2026, driven heavily by AI-related demand. Forecasts of roughly $5.3 trillion in hyperscaler capex between 2025 and 2030 suggest this is seen less as a one-off bubble and more as a multi-year investment program. That backdrop is underpinning an AI-led equity rally, with chipmakers like Broadcom and Marvell enjoying triple-digit growth in AI revenues and frequent price target upgrade for names such as ASML and leading software security firms. Beneath the headline enthusiasm, the winners and laggards are becoming clearer. Anthropic is cited as economically viable, with revenue per gigawatt of around $20 billion, roughly double an industry average that is seen as insufficient for strong returns. In contrast, OpenAI is flagged for heavy cash burn and is still in proven path to profitability, raising questions about prospective IPO valuations that in some cases are discussed around 100 times revenues. Upcoming listings for SpaceX, Anthropic, and OpenAI are expected to trade with implied volatilities near 100, and a possible $2 trillion valuation for SpaceX could trigger as much as $500 billion of passive and ETF demand, making liquidity as important as price for public markets. The hardware landscape is also reshuffling. Broadcom's semiconductor revenue from AI has jumped 143% year-on-year to more than $10 billion, supported by long-term partnerships like its custom chip work with Google through 2031. Meanwhile, Intel is reported to be losing ground on performance per watt as alternative ecosystems gain traction. At the same time, demand for running AI on edge devices is accelerating as users seek personalization, privacy, and offline access, benefiting chipmakers such as Qualcomm and MediaTek and slowly diversifying the AI trade away from a pure data center story. Against that positive growth narrative, cost and capacity constraints are becoming more visible. Token prices have roughly doubled in 6 months, prompting firms like Uber, Priceline, Walmart, Amazon, and Microsoft to clamp down on AI usage budgets. And some executives report limited evidence so far that higher AI spending is translating into clear product improvements. On the infrastructure side, power, water, and labor are emerging as hard bottlenecks, with projected power shortfalls through 2028 and more than $150 billion of U.S. data center projects delayed or canceled after local opposition. Policymakers are floating ideas such as excise taxes on AI data centers, both to address externalities and to fund retraining for workers who may be displaced by automation, while others warn that heavy taxation could blunt U.S. competitiveness against China in advanced technologies. All of this feeds into a more finely balanced risk profile for the AI theme. On one side, AI-driven optimism remains strong enough to outweigh concerns about geopolitics, tariffs, and higher oil, delivering the longest equity winning streak in over a year and leaving many AI-related names trading at demanding multiples. On the other, signs of bubble-like dynamics are building, with major AI IPOs coming at very high revenue multiples, some credits dependent on aggressive growth to service debt, and worries that a wide gap between wealth and income could force asset sales if taxes or funding conditions tighten. Looking ahead, the market is likely to focus on how upcoming AI-heavy IPOs price and trade, whether hyperscalers stick to ever-rising capex plans, and how proposals to tax or regulate AI infrastructure evolve. The same data centers driving this earnings boom are also power-hungry, which brings us directly to the renewed focus on geopolitics and energy. Geopolitical risk is once again exerting real macro influence, with the Middle East back at the center. Renewed tensions between the U.S. and Iran, including intercepted missile and drone attacks and strikes that damaged Kuwait's main airport, have pushed Brent crude toward $100 and lifted WTI by almost 3%. Oil has now risen for a third straight day, and inventories are drawing at an estimated pace of around 8.5 million barrels per day, raising the odds of an uncomfortable squeeze into the peak summer demand season. The Strait of Hormuz remains the key choke point. Negotiations over a ceasefire and shipping deal are stalled by disputes around Iran's nuclear program, frozen assets, sanctions relief, and parallel conflicts in Lebanon. Both Washington and Tehran appear to be engaging in calibrated escalation to maintain leverage without crossing into full-scale war, yet that very strategy keeps markets on edge. Efforts to move tankers out of the Gulf have increased, but much of the current flow is one-way shipping from floating storage, suggesting any relief is temporary while underlying tightness persists, especially in refined products like jet fuel and diesel. Higher energy prices are already feeding into inflation and rate expectations. Rising crude and gas prices have pushed yields higher across global bond markets, reviving stagflation concerns and undermining the diversification investors once expected from a simple 60-40 equity bond mix. The OECD now warns global growth could slow toward 1.8%, with inflation projections for 2027 revised up, and at least one Bank of England policymaker is arguing that Iran-linked inflation risks justify a more hawkish stance. If disruptions in the Middle East persist beyond the third quarter, some scenarios even point to U.S. rate cuts being delayed toward 2027, keeping real yields elevated and pressuring long-duration and speculative assets. The impact is uneven across regions. Energy-intensive industries in Germany and emerging Europe have already seen sharp output declines since 2022, and renewed rises in gas and oil prices risk stalling disinflation and pushing those economies toward a stagflationary mix of weak growth and sticky prices. Several North African countries, heavily reliant on food imports and subsidies, are particularly vulnerable to any renewed food price spike that might follow higher fertilizer and transport costs, which could strain fiscal balances and debt servicing. In Asia, net energy importers face sustained currency pressure and more difficult policy trade-offs compared with exporters like the U.S., while European equities are underperforming on fears of higher energy costs, a stronger dollar, and renewed tariff risks. Trade policy is amplifying the geopolitical noise. The U.S. is considering new Section 301 tariffs of at least 10% that could be more permanent than previous measures, alongside a separate regime imposing roughly 10 to 12.5% tariffs on goods allegedly produced with forced labor from around 60 trading partners, including the EU, UK, China, Japan, and Korea. While officials hope these steps will not derail U.S.-European trade negotiations, they add legal uncertainty and raise the risk of retaliation, particularly from China, where tensions are seen as structurally persistent despite recent diplomatic overtures. In an extreme scenario, analysts warn that a Chinese blockade of Taiwan's semiconductor exports could trigger a sharp sell-off in technology and AI equities and accelerate the shift from efficiency to security in global supply chains. For now, markets appear to be pricing in continued tension but avoiding the worst case. Brent remains below the psychological $100 threshold, and natural gas and LNG prices are relatively restrained thanks to earlier capacity additions and disciplined buying, suggesting some confidence that new supply and demand management can contain shocks. Still, many participants see the risk of an extended Strait of Hormuz disruption as underpriced, with the potential for a nonlinear move in energy prices and volatility if blockades persist into peak demand. Key markers from here will be tanker flows and inventory data into July and August, the trajectory of U.S.-Iran talks, how quickly new tariffs are implemented or challenged, and how central banks frame energy-driven inflation. Those macro and policy outcomes will heavily influence not only public markets, but also the more opaque world of private credit and private equity where liquidity strains are building. Signs of a liquidity crunch are most visible today in private markets. Private credit funds have faced rising redemption requests, and an increasing number of private equity and evergreen vehicles are now capping withdrawals, with several funds imposing quarterly gates at around 5% of net asset value after requests approach 10%. Partners Group has become a focal point, with its stock falling sharply toward multi-year lows after restricting withdrawals from a flagship private equity fund, reinforcing investor worries that stress is migrating from private credit into the broader alternatives complex. Flows suggest the stress is concentrated in semi-liquid products and retail channels. In at least one $8.6 billion European private markets fund, almost 10% of assets were requested for redemption in a single quarter, largely by individual investors in Asia-Pacific and Australia. Across the industry, private equity and private credit managers have increasingly targeted retail investors with lower minimums, which boosts asset gathering, but also exposes funds to higher redemption risk and sharper swings in flows when sentiment turns. Gates are being used as designed to protect remaining investors and preserve the ability to invest, but the optics of restricted access contribute to volatility in listed asset manager equities. At the same time, there's a clear distinction being drawn between structural liquidity issues and underlying credit performance. Partially liquid private credit funds account for only about 10 to 15% of the overall market, and many managers report year-on-year growth of 25 to 30%, with institutional investors maintaining long-term commitments and even viewing the current environment as an opportunity. Several funds remain well-funded with credit facilities, and the decision to cap redemptions is presented as a way to avoid forced selling rather than a response to imminent defaults. In this view, investor anxiety is driven more by fund design and the realization that these assets are not cash substitutes than by a broad deterioration in loan books. Even so, the risk narrative around private markets is shifting. Credit quality deterioration has overtaken macro volatility as the main concern in private credit, and there's growing unease about heavy issuance, elevated valuations in some AI-exposed deals, and the possibility that higher debt service costs and fiscal strains could test weaker borrowers. Private credit is tightly linked to private equity, often at loan-to-value ratios near 40%, so stress in one segment can quickly spill into the other, especially if exit markets slow. At the same time, a backlog of older private equity assets is being worked through via secondary sales and refinancings, gradually adapting capital structures to a higher rate world, but also tying returns more closely to liquidity conditions in public markets. Liquidity considerations are also intersecting with the AI and IPO themes. A potential $2 trillion SpaceX listing could absorb hundreds of billions of dollars of passive and ETF demand, while a broader wave of AI-linked IPOs at very high revenue multiples is set to compete with private credit and equity fund for capital. With roughly $250 trillion of global liquidity, the system is far from cash-starved, but the combination of gated funds, concentrated flows into AI leaders, and elevated valuations raises the stakes for how any negative shock might propagate. From here, many allocators are likely to track the breadth of redemption pressures across private vehicles, default rates in private credit, and the reception of large IPOs as key gauges of whether today's liquidity stress remains contained or evolves into a more systemic constraint on risk-taking. To sum up, the AI capex boom is still delivering powerful earnings support and leading the equity tape, but it now comes with rising costs, capacity constraints, regulatory debate, and more visible valuation risk. At the same time, Middle East tensions and new tariff regimes are lifting oil, inflation expectations, and yields, putting stress on traditional diversification and creating clear regional winners and losers. Under the surface, private credit and private equity are undergoing a live stress test of semi-liquid fund structures, with redemption gates and sharp moves in listed managers highlighting how sensitive liquidity has become to shifts in sentiment, even as many fundamentals remain intact. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.